So let's jump right into today. So today, again, we have a special segment to end off 2011. We're going to begin the introduction with Mark Sherry. Mark is with Stroma, and he'll give us a brief statement when we get started on why he chose OneLife Wealth Management. And our speakers today are Sylvain Cote, who's owner-president of OneLife Wealth Management in North Bay. Sylvain started his career at age 22 and has been in the insurance and financial services industry for 16 years. At age 38, he's the owner-president of OneLife Wealth Management in North Bay and works exclusively with business owners, entrepreneurs, and retirees to help them protect their incomes in case they get sick, disable, or die. Hopefully not the latter too early. He provides good financial advice on how to structure insurance and investment contracts so they are tax effective while paying the premiums, and make sure they are tax effective when claims arise. And also with him is Bill Holmes, who's also president of OneLife Wealth Management. Bill graduated from Carleton University in 1984 with a degree in economics. Bill entered the financial services industry in 1987. He has held many positions in this industry in both financial center management and as an advisor to clients. Bill founded OneLife Wealth Management in July of 2005. He believed that his company would provide financial services to clients through a formalized process that would focus on tax-effective solutions. Bill has been providing tax-effective planning to successful business owners for over 24 years. And Bill also speaks nationally on the tax issues facing business owners with holding companies. So again, a special segment here on Thought Rock Live, and I know that the people that are attending obviously have some very significant concerns and are looking for information in this area. So with that, I will introduce Mark, Sylvain, and Bill.
Thank you. It's Mark Sherry. I'm actually a client of OneLife, and the reason I thought I would use this as a session is that in IT, unlike many businesses, there's a lot of subcontractors that we use in our consulting and resourcing division, and I thought the subcontractors usually have their own incorporated companies, and they could really benefit from some of the way and some of the services that these folks have to offer in terms of tax planning. So I'm going to turn it over to Bill, and he'll get started, and away we go.
Great. Thanks very much, Mark. Welcome, everyone. I'm going to take you through a few slides. We're going to provide a fair amount of information. Please feel free to ask questions at any time. We're always happy to expand on anything. If I could get going with our slides, what we really want to deal with is if you happen to be fortunate enough to have a holding company and you do have passive assets inside that holding company. Before we get to that, I want to cover a few assumptions that we need in place to do this work for what we would call an ideal client. And certainly you need to have a profitable operating company. That has nothing to do with the work that we do. That's everything that you folks do on a daily basis. We do like to see limited debt. I will say that in today's interest rate environment, debt isn't such a bad thing when you can borrow money at sometimes 2 and 3%, and if it's deductible, even better. We like to see some personal assets. Hopefully you have an RSP portfolio, possibly a home, a cottage, maybe a personal investment portfolio. You may own some real estate. And I do say at the bottom, point 5, the future sale of your operating company, that may come into play. The only reason we have that there is that we're going to put a structure up that you may or may not have seen, and I'll just sort of walk you through all the bullet points on that and why. Again, it's not the only corporate structure in the marketplace, but it's certainly one that we feel is very effective from a tax perspective. We like to see the common shares of the operating company owned by the family trust. And then we like to see beneficiaries of the trust, whether it be spouse, children, or other family members, but ultimately we like to see the holding company as a beneficiary of the family trust. The reason we like that structure is it does a few things. It really is very positive from a tax planning perspective. It allows, if you do happen to sell your operating company in the future, it allows for a multiplication of the capital gains exemption through the trust out to the beneficiaries. So in Canada, the capital gains exemption runs at $750,000. If we can multiply that by, a spouse and a couple of kids and possibly a holding company, we can take that up to $3 million. So that's not a bad scenario. It also allows for effective income splitting through the trust. When I get to the flow of wealth, you'll sort of see an example. We'll run some money through the operating company into the trust and the holding company. And what it does is it allows some money to go out, assuming your spouse and your children are above 18 and your spouse isn't making too much money. it certainly allows for some income splitting there. And then ultimately, what we see when we work with business people is the majority of their wealth ends up inside a holding company. And I say the majority of their wealth, excluding the value of their operating company. That's the true value of their wealth. But the cash ends up, or should end up for tax planning purposes, inside the holding company. And that's really where we can do the most amount of work that we can do will be inside the holding company. So if I could just go to a little farther, and I'll walk you through kind of an example of what we see here. And again, what I said at the beginning is there's really nothing we're going to do on the operating side of your business. You're going to generate revenue the way you do. You're going to take some money out of that. You're going to pay yourself. Possibly there's going to be some bonus. You're going to run expenses, and then there's going to be tax. So what we've done is we've assumed in this example that your operating company makes $250,000 after you've been paid. And what you'll see in that scenario in Canada is that $250,000 is taxed at about 16%, and that leaves about $210,000 of after-tax corporate profits that can be moved to the family trust. And then, if you're in the right situation, we actually are able to move, of that $210,000, we're able to move as a dividend, tax-free dividend, out to the spouse, and usually around $50,000. We see that in a lot of situations. Of that $210,000 can move out to a spouse, and $50,000 to a child. In Canada, that will trigger about $3,000 or $4,000 of tax on their returns, assuming no other income. And then what we're going to see is the remaining $110,000 is going to flow down into your holding company, and this is where you're going to be surprised. I think most of our business owners are on what they see in Canadian tax legislation. And all I've done is I've shown an example. If we move $110,000 in there for year one, and we assume that this same scenario happens over the next 7 years, eventually there will be about $770,000 inside that holding company. And the last few points on the bottom is to access that cash for the owner, you're going to pay a 32.5% dividend rate in Ontario. If anything ever happened, there's a 23.2% capital gain attached to the holding company because it seldomly qualifies for the capital gain exemption. And on top of that, if you make some investments inside that holding company, the government takes 47.67% of those investments in passive investment tax. So our work kind of came from the reality of hearing how business owners in Canada get such preferential tax treatment, small business owners, and when we actually look at the math through this, it really doesn't seem like it's very preferential. So that's what we see in terms of a flow of wealth, and we're going to work off of that example. The first thing that I like to point out to clients on the corporate tax side is that if you had that $770,000 inside a holding company and you want it, the dividend tax cost on that's $250,000, which means really $770,000 while you're alive inside a holding company is only worth $520,000. And I say that's important because what we do find is that holding companies do tend to, once assets get into them, once cash and investments get into them, they do tend to grow because operating businesses are creating your everyday income. So, and we have people say, I'd like to, possibly use some of the profits that we've made over time period, but when we turn around and we say to them, you got to pay a $250,000 dividend to access $770,000 of your money, it's not very exciting. At the same time, on the estate side, and I'm not trying to get rid of anyone here, but eventually we will all be gone, the holding company with $770,000 in it has a couple of other tax costs. That would trigger a capital gain on the estate of $177,000, and then ultimately, even if the shares get passed to the next generation, they have to take that cash out via dividend, which is going to trigger another $250,000 shareholder dividend tax cost. So when we look at it from an estate perspective, a holding company with $770,000 of assets is really worth less than half to the owner, $343,000 in our example there. So what we would say and what we believe is a better wealth strategy is taking a look at a structure where we want to avoid that scenario that I just walked you through, where you've got $770,000, you've got to pay $250,000 to get it out, and it's really only worth $520,000. We like to see a solution, and we use insurance in this solution, and we use investments, and we use a corporation, and we use yourself as a personal tax-paying Canadian. And what we do is we structure everything according to the tax regulation around insurance contracts. What we do is we leave, if you look in the bottom of that slide, you'll see an insured account. That's the actual death benefit of the insurance contract, and we leave that inside the holding company. In this example, it would be worth $2.5 million. At the same time, over a time period, and again, in this example, we move $110,000 a year out for 7 years. We rebuild it in the owner's name in a bond and mortgage portfolio, so we're very conservative. We rebuild that $770,000 outside the holding company. And again, in this example, our tax cost on it is $28,000. So we have a pretty good situation when the situation is right.
So Bill, how does the Canadian Revenue Agency view this structure?
That's probably the most important question of this, and that's there's a tax line with insurance contracts, and what CRA says in advance is that every single situation has to be reviewed on a case-by-case basis. The reason that happens is that people are different ages, they have different amounts, and also tax rates and life expectancy can change, and they all go into the calculations of the work that we do. At the same time, it's very important from our perspective that we keep all of the details. So on audit, and I'll tell you that we certainly have had some clients audited on these scenarios, anytime money comes out of a corporation, CRA wants to understand why you're paying $28,000 in this example instead of $250,000. And it's very important that we keep all the terms and conditions of the insurance contract. And what that really means is the size of the insurance contract, the size of the deposit, the length of the time period that you make the deposits, and the size of the investment account have to pass a tax line that's in place in Canada for insurance contracts.
So why do I need to buy life insurance for this to work then?
Again, Mark, a very good question, but life insurance has the only preferential tax treatment for corporate funds. So when you combine life insurance with investments and a corporate structure, there is an opportunity for business people to access some of the profits without triggering the dividend tax cost. When you look on my slides here, if you look at the tax cost, the difference between the $250,000 at the top and the $28,000 in the bottom part, the $28,000 is a taxable benefit that goes on a client's return for accessing the cash inside the holding company. So life insurance becomes very important. If we don't put that $2.5 million of coverage in place, we can't move the $770,000 out of the corporation, and we certainly can't do it for a tax cost of $28,000. If I could just sort of go to the last part of our presentation, and then I'm going to turn it over to my partner, Sylvain. I'll just give you sort of the observations that we've seen with our client base over the last 25 years. And what happens when we look at someone's retirement situation, which is really the reason why most of us go to work, is to build enough assets so that one day we don't have to work any longer. Holding companies with cash in them tend to be the last asset used for retirement. And I say that because our clients have RSP portfolios. They either sell their business or they continue to take income from their business in a reduced role in retirement. And they also have some personal investments. And our analysis with successful business guys and gals shows that makes up the majority of their retirement income comes from those assets. At the same time, clients will say to us, what happens in the future if those assets don't fund my retirement? We certainly have the ability to leave some cash in the holding company and dividend some money out, assuming the tax rates make sense. So what we're really trying to do is eliminate the passive investment tax at 47.67%, top marginal dividend rate of 32.57, and your capital gain exposure at 23.2. And I guess my last comment, point 5 on that, would be that without proper planning and looking at some of the strategies that are available in the marketplace, your wealth becomes seriously eroded without proper planning.
Okay. I have another question for you, Bill. So why have my other professional advisors not really brought this to people's attention?
Yeah, we get that question a lot, Mark, and I guess I don't want to be hard on other advisors. Everybody has a specialty, and that's really what I've found is that most advisors specialize in one area. Some will be on the accounting and tax side, some will be on the investment side, others will be on the insurance side. But what we've really done here is we've put the combination of tax, investing, and insurance together with corporations and your personal situation as a tax-paying Canadian. So it's really, we're in a bit of a niche market. As you know, not everybody is fortunate to have a fair amount of cash inside holding companies that aren't needed to be reinvested back in operating companies. It's just been an area that we've decided to specialize in, and really tax drives the business planning part of this. There's lots of great tax people in the world, and without accountants and lawyers on the tax side, we don't have the structure in place. But nobody really wants to dip into the tax side of things and then take on the responsibility of the investment side and then throw in the insurance, because we're really getting into 3 or 4 areas at the same time. So we've just decided to build our practice that way, and it's become quite successful for us, and we've had a lot of, as you know from dealing with us, our clients seem to be happy with the work we do. So
okay. Now, if I'm a subcontractor and I have my own company and I have excess cash building up in this company, but I don't have a holding company, would this scenario work for me?
It can work, and one of the things, we certainly see that. The one issue we have in that scenario is you do want to get cash out of operating companies. There's some tax implications. There's some reasons for claiming capital gain exemption in the future and a little bit of creditor protection. So in general, we could do it that way. What we'd like to see is a reorganization of that existing corporation, and we would suggest to your lawyer, or to your accountant, or the other people that are doing the work on it, we would probably suggest that first slide I had where we throw a trust in, we do a reorg, we move the assets out of the existing operating company, the cash assets only, through the trust into the holding company, and then we'll put our structure in place in the holding company. It's not critical, but certainly, from an overall tax and wealth perspective, that would be your best way to go. So I'll pass the next part of the presentation over to my partner, Sylvain, and he'll take you through a couple of other ideas on it.
Thank you, Bill. So, like Bill was saying in the presentation, proper planning with company money and things like that is so important. One of the things that we always try to explain to business owners is that we really try to hit home and keep it really simple for them to say, listen, all this is all well and good as long as you don't get sick or disabled. And the stats that we have from our insurance companies and stuff is that the chances of becoming disabled for 90 days or longer, at least once prior to age 65, are 1 in 3, and that average disability lasts about pretty close to 3 years. So it really can affect all the planning or all the money that the corporation might be making, or the financial obligations that people have. It can really affect the outcome of that without proper insurance. So today, I just wanted to go and speak to you guys about the topic of insuring your most valuable asset, and that's you and your ability to earn an income. Insuring your income is basically ensuring your ability to continuously get some kind of revenue if you get disabled. Why? It's because most people, if they can't work, they don't earn any income, and if they don't earn an income, they struggle to find a means to continue to feed their family and possibly pay for their mortgages or things like that they may have. It's basic and fundamental elements in financial planning. This is often overlooked by business owners or individuals, and a lot of times it's overlooked by advisors also, because insuring your income is really not mandatory. The government doesn't tell us doesn't obligate us to take insurance out on our income. The government tells us that we have to have car insurance, so we have to buy it, because if we don't, we're going to get charged by the cops if we get stopped. And then obviously common sense tells us that we need to buy a house. We need to buy house insurance in case there's a fire or theft or whatever, so we protect that. But yet, if we don't protect our ability to earn an income, none of the toys and none of the possessions that we have that we insure can be owned without our ability to earn an income. So one of the things that we remind our clients is that as a business owner, you're often affected in both ways, in your personal life and in your business life. And you, as business owners, you have the ability. It's really important to protect yourself in both scenarios. The next slide, there's kind of a lot of numbers there, and it might be a little bit hard to follow, but I just wanted to give you an example that if you were 30 years old, earning $70,000 per year, and that salary was averaged, would grow by 2.5% every year, your potential income from 30 years old to 65 years old is over $3.8 million. And if you were 35-year-old, for example, earning $70,000, same scenario, the income grows at about 2.5%. Until age 65, your earnings are going to be about $3 million over a 30-year time period. And for a 40-year-old, if they're earning, if you look at the 40-year-old and they're earning $150,000, well, the income potential on that till age 65 is in excess of $5 million. So if you had an asset that was potentially worth $5 million, basically the question that we always ask our clients is, if you had an asset worth $5 million, would you insure it? And definitely most people would say, again, common sense would prevail, and they'd say, yes, we're going to insure that. And then obviously the question is how much would it cost to insure, $5 million or $3 million, whatever the future potential income might be. And the question for that is really, if a 35-year-old was to protect their future income potential, it would cost about $100 to $150 a month as an investment. And if the 40-year-old wanted to protect his $150,000 a year, it might cost anywhere between $300 and $350 as an investment. And I say as an investment because the reality is that most individuals really downplay the disability fact, and they always think that it's going to happen to somebody else and never to them. And everybody hates paying the disability premiums because they really think that it's not going to happen to them. It'll happen to their neighbors or whatever, but not to them. So for that, I say it's an investment, because if you don't get disabled, the insurance company basically will refund half of the premiums that you've paid into the policy. So it really is an investment. And every 7 years, basically, if you pay your premiums on this at the end of the 7th year, if you haven't put in a claim, you'd get half of the premiums that you've put into it. It really becomes a really great investment planning tool in case you don't get disabled. And if you do get disabled, then obviously it covers the income that you were earning. So it's kind of good in both ways. The next slide is basically, we often get asked who should own the policy and who should pay for it. And really there's two ways and more to individually set up these things. One is if you can individually own the policy as a corporate business owner, you can individually own the policy. and also individually pay for the policy. So if your premiums were $2,000, for example, you'd be using after-tax dollars to do that. So in order for a business owner to pay an after-tax personal expense of $2,000, in reality they have to take out $3,500 to $4,000 out of the corporation, and so tax gets eroded, and really it increases the premiums for nothing. What we've found best is that usually the corporation should pay for the policy, and this way you're using after tax or after corporate tax dollars, which runs at about 15.5% right now, as opposed to personal taxes can go up to 46.4%. So it really is important on who owns the policy. And one of the things that we always look at is the who owns the policy, and really we try to work with sometimes with the current advisors or whatever to make sure that everything is done properly. So basically, in summary, accident and sickness are really a fact of life. We're not invincible, even though we think we are as business owners. We really aren't invincible, and your ability to earn income is your most valuable asset. So in our words, protect it. Choose to use corporate funds or personal dollars. It's really up to you, and your advisor can help you with that. And if you don't have the return of premium option on your policy, really consider talking to your current advisor or talking to us about it, because it really is a really great investment to have, and the premiums for the return of premium is really cheap, considering what you get back if you don't put a claim in. So I just like to end our conversation. I'd just also like to thank everyone for tuning into Thought Rock. How you can contact us with Bill or myself, Sylvain. You can contact us directly through email, or you can call us. We're both available via email or phone. And Bill is located in Ottawa. I'm located in North Bay, Ontario, and we're licensed to do business in Ontario, and in Canada we've got some people that we work with right across Canada that can help anybody that's looking for information there.
That's great. Can I ask a couple of questions, guys? Just a couple of questions that we have here. Great. So just in terms of how the payouts typically work, do you typically have some sort of a structure where the payout would go up as your income would go up in the future?
You're talking on the disability?
Yes.
Yeah, you could. It's basically an insurance on top of an insurance that you can do, where you can do cost of living, that if you're disabled for an extended period of time, the disability income that you're going to be receiving is actually going to grow by 4% per year. Or if you're not disabled, you can put a rider on your policy. It's called Future Earnings Protector, and basically what that does is that it insures your possible future income. So if your income grows exponentially from 70,000 to 150,000, and you become uninsurable during that time, well, with this future earnings protector, it'll actually guarantee that you're going to be able to buy disability coverage regardless of your health. So it's a way to protect it even if you're not insurable in the future.
Okay. And typically, are the payouts taxable the same way? It's regular income, I'm assuming.
No, actually, depending on how it's structured, we set them up where when you get disabled, the monthly income that you're going to get ends up being a tax-free benefit.
Okay. Okay, good. And typically, how do those plans work in terms of how long can you draw the payments? I mean, is it forever or until you're 65, or how does that typically work?
It goes right up until age 65.
Okay. Okay, great. I mean, again, if you want to just flip back to your slide back there just to make sure that anybody that wanted to contact you guys directly has that. I want to make sure they've got that information. So I'll just hold it there for a second while I just do a couple more things here. But yeah, so again, I want to thank Bill and Sylvain for joining us, and for Mark for recommending it. I mean, again, from a Thought Rock community perspective, we are always looking for ideas for content, even content that's not necessarily specific to the IT service management process space. But I think this is a great way to end the year, and I think having a group of folks that were interested in this content and staying around to hear about it, we appreciate that, guys. So their information is up there for those of you that are on the line, and please take their email and their phone number down if you have any further questions. I'm sure they'd be more than happy to answer. And I'm sure they're very accessible. So we thank you very much. And Mark, again, thanks for making the recommendation and bringing the gentleman to Thought Rock Live today.
You're welcome.
So on the last slide there, again, for everyone, just again, if for whatever reason you always know that if you need to reach out to people and you've forgotten their contact information, everyone for the most part always has this information down, but there it is again, the email as well as the phone number for Thought Rock. And again, I want to thank everyone for, if you have attended before, for a great 2011. We had some record-breaking session attendance, and has continued to grow almost each quarter with the level of attendance on Thought Rock Live, as well as a growing membership. So again, we will reconvene on January 17th with Graham Furness in the Untitled 2011 refresh has changed. So hopefully everyone has a good holiday season, and we will see you soon. We'll leave the Thought Rock slide up here again, as we normally do, for you to take down information if it's needed. And we'll see everybody or hear from everybody on January 17th. Thanks again, guys, and we appreciate it, and good luck with everything.